Look at the sheer mechanical force required to harvest at this scale. Brazil is an undisputed agricultural powerhouse, dominating the physical supply chain with heavy, capital-intensive operations. This sector drives roughly 25% of the country's gross domestic product, generating over $160 billion in annual exports. But despite managing the operational risks, from unpredictable climate shifts to currency fluctuations and global pricing swings, the primary producers usually retain a profit margin between 5 and 15%. This diagram illustrates the trap. On the left, we see the massive flow of that $164 billion export volume. But look at the right side. It constricts into a tiny trickle of retained profit. The current model relies entirely on increasing crop yields to grow revenue, rather than increasing the value of the crop itself. When a system depends strictly on volume, it leaves the entire country exposed to external variables. The producers hold the physical assets, but they lack the power to dictate the final price. Moving millions of tons of raw material at these margins means Brazil is effectively subsidizing the raw inputs for the rest of the world. Those raw inputs flow directly into the silos of multinational corporations like Unilever, Nestlé, and Cargill. These entities generate staggering revenues. We are looking at $60 billion for Unilever, $100 billion for Nestlé, and $160 billion for Cargill. Their profit margins sit comfortably in the 15 to 20% range. Here is the core difference in their operating model. They do not farm. They buy the low-margin commodity, process it, brand it, and place it on a supermarket shelf. The Brazilian model effectively abandons the supply chain right before the highest margin activities begin. Overcoming this asymmetry requires moving beyond agriculture. It is a system engineering and capital allocation challenge that requires a new corporate architecture. To prove the math behind this value capture, let's trace a single commodity, raw corn. Sold in bulk, its unit economics are extremely low, hovering around 2 reals for a standard equivalent base. This chart shows price evolution. Transforming raw corn into packaged popcorn pushes the value to 10 reals. In a specialized environment, like a theater, that same volume is worth 40 reals. Apply premium positioning, like truffle-infused popcorn, and the value rockets to 100 reals. The physical agricultural input never changed. The kernel of corn is exactly the same. That 50x price multiplier is purely the result of corporate infrastructure. To capture those multiples, producers have to build a structured ecosystem that houses scientific research, private capital, and brand operations under one roof. We call this the IBRA framework. It is a 3-layered economic architecture designed to engineer commodity producers into global holding companies. The primary obstacle to making this leap is the extreme cost and risk associated with initial research, development, and product validation. This diagram outlines the structure, starting with Layer 1, the institutional base. This is a nonprofit institute that functions purely to absorb early-stage risk, building a pipeline of validated products without requiring immediate returns from private capital. This layer operates through corporate tax incentives. Companies direct up to 4% of their lucro real tax burden to fund the institute. The institute takes those funds and partners with existing, fragmented infrastructure like Embrapa, Senar, and universities to conduct applied scientific research on the raw materials. By utilizing tax offsets, the ecosystem effectively socializes the heavy risk of research and development, while privatizing the eventual upside, creating a de-risked launchpad for new businesses. Once a product's chemistry, processing, and market viability are successfully validated by the institute, the system shifts strictly to a for-profit capitalist logic. This brings us to Layer 2, the strategic holding. This layer organizes direct private investment, dictates strategic direction, and holds equity in the eventual spin-off companies. The holding creates special-purpose vehicles, or SPVs, for each validated product, isolating risk for investors. Finally, we reach Layer 3, the operational enterprises. These are the actual consumer-facing companies spun out of the holding. Their function is highly specific. They purchase the raw commodity from the producer base, execute the industrial processing, and build the global brand narrative to sell to the end consumer. This strict separation of duties, an institute to de-risk, a holding to capitalize, and enterprises to execute, is the exact corporate anatomy used by the global north to dominate the market. Traditional agricultural scaling is linear. Buy more land, plant more seeds. The IBRA model relies on horizontal enterprise creation. We call this the brand tree network effect. A single validated agricultural base branches out into specific processing types, which then multiply into dozens of specialized, high-margin products across different global sectors. Because all these companies share the same institutional base and holding infrastructure, development costs and customer acquisition costs plummet for every subsequent launch. This shared infrastructure allows the ecosystem to move with the rapid agility of a tech startup while maintaining the massive supply chain security of a national cooperative. True economic scaling is about multiplying the amount of specialized corporate entities, extracting value from the volume you already have. This system extends beyond physical goods. Modern global markets place a multi-trillion-dollar premium on verifiable environmental, social, and governance metrics. To capture that premium, the system integrates EcoLedger and the Gaia Coin protocol. This is a blockchain-based infrastructure designed to precisely measure and verify environmental responsibility directly at the producer level. It takes the abstract concept of climate responsibility and transforms it into a hard, tradable economic asset, further increasing the value extracted from the exact same baseline operation. This integration optimizes the ecosystem for two distinct revenue streams: high-margin consumer products and next-generation institutional capital allocation. Let's compare the financial outcomes of the two models using a baseline of 100 million reals in revenue. Under the old commodity model, this yields a profit of 10 million reals. This chart compares the exact same volume of raw material processed through the two different architectures. Running it through the value-add IBRA framework triples the revenue to 300 million reals and expands the absolute profit up to 6 times, reaching 60 to 90 million. The macro objective is to build a global brand portfolio with a valuation exceeding $1 billion, capturing revenue in hard currencies like dollars and euros to eliminate reliance on the domestic market. We can frame this strategy through the lens of economist Joseph Schumpeter's theory of innovation. He theorized that true economic development does not come from simply expanding production. It comes from recombining existing resources into entirely new, more complex economic structures. Brazil has already won the war of production at scale. The IBRA framework provides the architectural blueprint required to finally win the war of profit at scale.